Dubai real estate in 2026 is still attracting aggressive capital, but the easiest mistake right now is confusing momentum with safety. Here is the number serious investors should pay attention to first. Dubai recorded transaction value of roughly 761 billion dirhams in 2025, and Q1 of 2026 is still showing strong year-on-year growth. That tells you the market is not dead. But it does not tell you where the low-risk opportunity actually is. If you want a shortlist that fits your budget, target yield, and timeline, message Astra Terra Properties on WhatsApp. We help investors compare ready, near handover, and off-plan options without wasting weeks on the wrong inventory. Welcome to Astra Terra Properties. This is your Dubai Market Pulse for March 2026. In the next few minutes, I will show you what the latest transaction momentum means, why the off-plan share matters more than most people realize, where yield still looks attractive, and how smart buyers should position from here. Let's start with the headline strength. When a market clears more than 761 billion dirhams in annual transaction value, you are not looking at a weak ecosystem. You are looking at a deep capital market with local demand, foreign demand, and user demand, and developer supply all pushing at the same time. That scale matters because it supports liquidity. Liquidity is what gives investors confidence to enter, hold, refinance, or exit. Now let's add the next layer. Q1 2026 transaction activity has been running around 18% higher year over year. That is a strong sign, but this is where investors need discipline. Growth alone does not mean every area is underpriced. It means the market still has energy. Your edge comes from choosing where that energy is durable and where it is simply marketing noise. The biggest structural clue right now is the off-plan share. If off-plan is around 58% of market activity, that tells you two things. First, developers are still very aggressive. Second, buyers are still willing to buy future delivery in size. That creates opportunity, but it also raises the importance of developer quality, payment plan logic, handover timing, and exit competition. In a market with heavy off-plan flow, the wrong project can look exciting on launch day and feel crowded on resale day. So, where does that leave ready and near handover property? For many cautious investors, this is where the market becomes more interesting. Ready stock gives immediate tenant reality. Near handover gives shorter duration risk. If your goal is cleaner cash flow, quicker market feedback, and more visible demand, these segments deserve real attention in 2026. Now, let's talk yields. In the investor zones people ask about most often, realistic gross rental yield targets still tend to cluster around 6 to 8%, sometimes more when the exact asset, building, and management are right. That is why communities with deep tenant pools still matter more than fashionable narratives. JVC keeps getting attention because entry pricing can still work. Business Bay keeps getting attention because tenant depth and centrality support liquidity. Dubai Marina still wins on recognizability and demand, but asset selection has to be precise. Here is the trap. Investors hear that Dubai is up, yields are strong, and off-plan is booming, then assume broad exposure is enough. It is not. In this phase, you need to filter hard. Ask whether a building has real tenant depth, whether the unit layout is easy to rent, whether service charges damage the yield story, whether the developer has execution credibility, and whether too many similar units will compete with your exit. If you are buying for capital appreciation, you may still like selective off-plan where infrastructure, developer quality, and timing line up. If you are buying for residency and stability, the 2 million dirham plus range with better end-user appeal can make more sense. If you are buying for income, ready or near handover assets in proven communities often give a cleaner investment case than a flashy brochure. Another thing smart buyers are doing now is separating macro confidence from micro underwriting. Yes, Dubai still looks strong as a market. Yes, the city continues to attract international investors. But the decision is not whether Dubai is strong. The decision is whether this exact unit, in this exact building, in this exact pocket, still looks good after fees, service charges, vacancy risk, and resale competition. So the March 2026 pulse is simple. Momentum is still real. Off-plan is still dominant. Yield remains attractive in the right communities. But this is a selection market, not a lazy market. The winners will be buyers who stay disciplined on asset quality, demand depth, and exit logic. If you want Astra Terra Properties to build you a smart Dubai shortlist based on your budget, risk level, and whether you want ready, near handover, or off-plan property, visit Astra Terra AE or message us on WhatsApp today.